Hello traders, welcome to my channel. I'm so glad to welcome you with this wonderful topic, how to frame a trade setup. I believe at the end of this you like it and it will help you in your trading career. So before we move on, if you haven't subscribed, make sure you subscribe and turn on your notifications so that you don't miss any of my wonderful content. Right, so let's go. A trade setup is the basic conditions that need to be present in order to even consider a trade. For instance, if you are a trader that enters trade on the basis of market structure shift, your trading plan should define what a tradable market structure shift is for your strategy. Frameworks surrounding trade setup are only four. These are expansion, retracement, reversal, consolidation. These are the only four scenarios in which algorithms deliver price, and all trade setup are framed from these four elements. These four are very important because all the trade setup you have in the world are going to be subset of these four. You cannot have a trade setup outside of these four, right? So it is very important and I will explain each and every one of them to you. Price delivery. This is according to ICT. Algorithm delivers price according to these four elements, and according to ICT teaching, I'm not the one that invented what I'm teaching you in this video, but it's according to ICT. I'm only adding some things to it based on my own understanding, right? So algorithm delivers price from consolidation to expansion, expansion to retracement or consolidation, or from expansion to reversal, reversal to expansion, expansion to consolidation, or retracement. This is how algorithm delivers price. And one fascinating thing is that you cannot have two or more of these happening at the same time. You can only have one of these scenarios happening in a particular instrument at a particular time. You cannot have consolidation and expansion at the same time. You can't have consolidation and reversal at the same time on a particular instrument. You can only have consolidation at a time and expansion at a time, reversal at a time, or retracement at a time, right? So institutional reference point that defines this framework are order block, fair value gaps, and liquidity void, liquidity pools, and stop run equilibrium. What this means is that these institutional institutional reference points, these institutional reference points is going to be paired with these price delivery elements, right? So maybe when price is expanding, it is expanding into one of these reference points or is expanding from one of these reference points. And when price is retracing, it may be retracing into one of these or it may be retracing from one of these. So, and this is the same for reversal and consolidation also. So this is why the relationship between institutional reference point and price delivery context is very important, and pairing them will help you tremendously in your trading, right? So we're going to look into each and every one of these and how you will pair them with this institutional reference point. So let's start with expansion. Expansion. This is when price moves quickly from a level of equilibrium. This indicates the willingness of the market makers to reveal intended price direction. This is what it means. When price is consolidating, there is no clear direction as to where the price will move next to. Price can either move up or move down. There is 50-50 probability of price moving up or moving down when price is consolidating. But when expansion has occurred, it will give you clue of where price is moving to next so that you frame your trade setup based on that. So What to look out for? When price expanded, what you look out for, the order block that price left at the level of equilibrium. This is what you look out for, so that price might retrace into that order block that price left at the level of equilibrium, right? So this is how it is on the live chart. Uh, we have price has been consolidating for some times. This is 1 hour chart of British pound, Swiss francs, and price has been consolidating for a while. How to determine the equilibrium of the consolidation is for you to take your Fibonacci and then measure from the high and low of the consolidation. The 50% of the Fibonacci is your equilibrium, right? So we have this order block at the level of equilibrium. Remember, when price expanded, what you look out for is the order block that price left at the level of equilibrium. So we have a smooth expansion of price. We have smooth expansion of price here. So this is our order block that price left at the level of equilibrium. We are going to mark it because we are expecting price to retrace into this order block and continue selling from the order block. And this is how the relationship of the institutional reference point and price delivery concept is, right? So I believe you are now understanding how to pair institutional reference point and price delivery context or element of price delivery, right? So this is for expansion. Retracement. This is when price moves back into a recently created price range. It indicates the willingness of the market makers to reprice to level not efficiently traded for fair value. What to look out for? Retracement, we are looking out for fair value gap and liquidity void. What retracement does is when price has expanded, price will retrace back into any place that is not efficiently traded for fair value. This is can also be said to be repricing. Price will reprice into a certain range and make sure it balances the movement, right? And what you look out for is fair value gap and then liquidity void, as we've said. So this is what it is. Now price have moved from this range to this range in an one-sided price movement, giving us liquidity void. What liquidity void means is one-sided price movement. As you can see, the movement of price from here to here is different from movement of price from here to here. From here we have a swift bullish run and then a little bit retracement here, then we have a run bullish retrace, then retrace and then up again retrace before going up. But here the case is different. Price moved one-sidedly and moves without any bullish candle, right? So here when you see such kind of price movement, there is certainty or there is tendency that price will reprice into this range because it is one-sided. This is referred to as liquidity void, and price retraces back into it, as we've said, to efficiently trade it for fair value. Maybe I was thinking maybe the sellers moved too deep with the price and the buyers could not enter. So they reprice back to negotiate with the buyers whether the buyers are ready to buy now. But it seems like the buyers are not interested in buying. So they continue selling from there. This is my analogy, right? It sounds interesting, but this is how algorithm delivers price. When price moves in one direction, it will reprice again before moving in that direction or changing direction. So this is retracement into liquidity void. So as you have seen, liquidity void failed, I wrote. So this is another form of it. Remember we say price retraced into liquidity void or fair value gap. So this is fair value gap example. Price moves here and left a fair value gap. This is 30 minutes price chart of Nasdaq on 20th September 2022. So after this nice expansion of price, we have a retracement of price into this fair value gap to efficiently trade it for fair value. So after it has traded into this fair value gap, we know that price has efficient price delivery now. So it continues moving down. As you can see, there's another fair value gap here that price has to retrace to rebalance it. So this is retracement, guys. I hope you are understanding it, right? Reversal is when price moves opposite its current direction. This occurs when the market makers have run a level of stops and significant move should unfold in a new direction. What to look out for? When price is price reversal is paired with liquidity pools. So what it means is that when price takes liquidity above all high, it tends to reverse, and likewise when price takes liquidity below all low, it tends to reverse also, right? So this is the example of it. Price took liquidity above all high, it took buy side liquidity and reverses, and also it took sell side liquidity here and reverses, and also it took buy side liquidity here, then reverse buy side liquidity and reverse. So this is the example of reversal. Consolidation is when price moves into a clear trading range and show no willingness to move significantly higher or lower. This allows price to build orders on both sides, right? This is when price is moving within a range and it is showing no willingness to move higher or lower, thereby building orders. And the orders is built on both sides. As I've told you earlier, when price is consolidating, you don't have a clue whether the price is moving up or down, but it has orders for both sides, either up or down. You have to wait for expansion to know the price direction. When price is consolidating, what you look out for is equilibrium, right? Here we have price has been consolidating for some time. I've told you how to mark your equilibrium, high and low of the consolidation. Then 50% of the Fibonacci is your equilibrium. So you should take note of the equilibrium or price range, because that is where the expansion is going to pick up from. As you can see, this is the 50% of the price range, which is the equilibrium, and you see price started expanding just a little bit above the equilibrium. That is when price started expanding, right? So this is consolidation. What you look out for, the equilibrium of the price range, right? I hope you like this video, and I believe you've learned a lot about this video. So let me know in the comment section, guys, if you really like the video. Tell me, and don't forget to give it a thumbs up, and also make sure you subscribe and turn on your notifications so that you don't miss any of my content. Thank you, guys. Have a good day and good trading.